A company has a value, and it has a price. The value, or equity, of a company can be measured by its net asset value, or by the cash flow it can generate every year. Shares in a company are traded on the stock market, where the share price fluctuates according to the laws of demand and supply. Traders who believe that the share price has dropped below the company's value in the short term will buy shares in that company to profit in the long term. In this episode, we look at one approach to value the equity of a company based on the free cash flow it can generate. How much are you willing to pay to purchase a company that is predicted to generate $100,000 in free cash flow next year? Consider this investment. If you pay $V to purchase this company, by the end of your investment horizon, in T years, the future value of your investment, F, will equal $V plus the free cash flow, C. We can also say that in T years, the value of your investment, V, grew at a discount rate, D. By substituting one equation into the other, we can solve for V and place a value on the company today. The only unknown variable now is the discount rate, D. You have heard of the expression, time is money. That's because, instead of spending your time doing nothing, you can use your time to earn money. There is a monetary value to time. But there is also a time value of money. Instead of keeping your cash under the bed, doing nothing, you can deposit the cash in a high-interest bank account or use it to purchase a government bond. With no additional time required from you, you at least have the opportunity to invest your unused cash in a relatively risk-free security and earn a minimal return. There would be an opportunity cost if you invested in another security that gave you less return than a risk-free product. Therefore, the discount rate is the minimum rate of return required by the investor to compensate them for the opportunity cost of investing in an alternative security. Depending on your investment outlook, you can use a discount rate equal to the interest receivable from a savings account or a government bond with the same yield to maturity as the investment horizon. You can equate the discount rate to the corporate bond offered by the same company, or an alternative asset such as a property lease. You can also modify the discount rate till the value equals today's stock price to compare the discount rate over time or against another company. Let's return to our original question. What value do you place on an asset that is predicted to generate $100,000 in free cash flow next year? Using our formula to calculate the present value of this company, we know the total cash flow receivable is $100,000 within an investment horizon of T equals 1 year. As an investor, the minimum discount rate we want to use is the risk-free rate, such as the U.S. Treasury bond, with a yield that will mature in 1 year. Assuming this is 2%, the maximum value of this company is $5 million. Now, let's modify the discount rate to compare this investment to a corporate bond by adding a risk premium of 3% to the risk-free rate. The discount rate is now increased to 5%. Taking the value of the company down to $2 million. In other words, you need to invest $2 million to earn $100,000 in free cash flow by next year at an annual rate of return of 5%. The value of your investment starts at $2 million and then increases by $100,000 in year 1. The future value of $2.1 million is discounted back 1 year at a discount rate of 5% to the present value of $2 million. Next, we will increase the investment horizon, T, to 10 years to value this company. If you like our content, please press the like button and subscribe to our channel. What value do you place on a company that is predicted to generate $1 million in free cash flow in 10 years? Let's extend this evaluation model to an investment horizon of T equal to 10 years. For convenience, let's also assume the same discount rate of 5%. Although in practice, you would use bonds with a yield to maturity of 10 years. And finally, Let's also assume that there is no growth in the free cash flow every year. Therefore, you accumulate $100,000 in cash every year. By the end of 10 years, the future value of your investment will be the present value plus $1 million in total free cash flow, C. The future value of your investment in 10 years is discounted back to the present value, V. Over a 10-year investment horizon, the value of the company today is just under $1.6 million. In other words, you need to invest $1.6 million to earn $1 million in free cash flow in 10 years at an annual rate of return of 5%. We can now compare the value of this company to its market capitalization. Or divide both numbers by the quantity of shares floated on the stock market to compare the share value with the share price. If the share value is less than the share price, the company is currently trading at a premium. But, if the share value is greater than the share price, then the company is currently trading at a discount for the investor to buy. Would you like to use our services to value an equity? Our analysts at Theta 45 will provide an analysis of the company's financial statements, project the free cash flow for the next 10 years, and use the appropriate discount rate to value the equity of the company. We aim to deliver the full report to you within 48 hours. For more information, visit our website at t45finance.com. If you are a day trader, download the Theta 45 app, available on iOS and Android. Theta 45 uses the science of probability and real-time AI to predict the next closing price. Create your trading plan before the market opens with Theta 45.